for joining us today, everyone. It's a real privilege to be able to share some insights with you. Some of you might be more familiar than others with the topic of behavioral finance, where we basically take the insights from psychological research and we apply it to financial decision making. So my goal for today is to provide you with some real life examples that you can relate to, relating to investor behavior, and hopefully everyone can walk away with some nuggets of wisdom that will help you to successfully navigate the noise in the investment environment. So we are going to start off by discussing the framework of two minds and how that relates to investor behavior. Then we're also going to delve a little bit deeper into behavioral traps, perhaps better known as investor biases in investment decision making. And I will also be sharing some empirical evidence relating to investor biases that we have come across at Allan Gray, as well as within the industry. But before I continue, I would like to do a quick experiment with you. I want you to read the text in the triangle that I'm just going to show to you now. I'm not going to show it for too long. Who of you are reading A Bird in the Hand? Please raise your hand. Okay, great. Majority. Who of you are reading something slightly different? Can I ask you to raise your hand? Okay, anyone who wants to share what it is that you've read? Any takers? Okay, so if you look closely, you will see that there's actually more than one "the" in the phrase. It's actually saying a bird in the hand. So you don't have to feel embarrassed. I was also caught out the first time round. So what we're dealing with here is an optical illusion. And an optical illusion occurs when there's an error in how the brain interprets what the eyes are seeing. So the brain is actually working faster than the eyes. You think you're reading the text correctly, but in actual fact, you're not. And like all illusions, it teaches us that our experience of reality is not always perfect. So what does this have to do with the framework of two minds? The framework of two minds describes how we make decisions. We as people make decisions with the help of our intuitive mind that form rapid judgments with great ease and without conscious input. So it's basically what comes to mind. We also make decisions with the help of our reflective mind that is slow, analytical, and require conscious effort. So most of the decisions that we make are products of our intuitive mind and is accepted as valid by our reflective mind, unless it's blatantly incorrect. Now it's the failures of the errors of the intuitive mind together with the failures of the reflective mind that interest behavioral academics. And as we can see from this example, the intuitive mind can lead one astray. And another insight that I would like to leave you with here is that we as humans are sometimes as susceptible to cognitive illusions as we are to optical illusions. And these illusions, also known as biases, they stem from mental shortcuts, which I will explain in greater detail further. Now, the Nobel Prize winner for economics, Daniel Kahneman, wrote a book called Thinking Fast and Slow. Some of you might have read this book. I can definitely recommend reading this book. But the title of his book is referring to the human brain's revolutionary double processor. So Kahneman thinks of the brain as having two systems. System one, which is the intuitive system, very similar to the intuitive mind that I've just explained. Then system two is the reasoning system, which is very similar to the reflective mind that I've just explained. Now, system one is programmed to perform tasks such as initiating a fight or flight, tying your shoelaces. System one happens automatically, quickly, with great ease. It can also conduct numerous tasks simultaneously, such as retrieving memory, monitoring events, detecting threats, opportunities, and generally, most observations are correct or conclusions are correct. System two, on the other hand, this is where the reasoning is taking place. So this is where deliberate thinking and careful analysis of a particular situation at hand takes place. System 2 is very powerful, but it has limited capacity and it can deplete energy rapidly. So the purpose of Kahneman's book was to show how the coordinated functions of these two contrasting systems make human brains and minds uniquely powerful. Yes, both these systems, they have their own bugs and features, and the interaction can prevail or can lead to poor judgment, as we've seen with the triangle example. But this is where Daniel Kahneman and other behavioral scientists come in to say, we will develop some tools to recognize some of these mental pitfalls and also to avoid some of these mental pitfalls. And if you ask yourself, most of us will probably say, well, we kind of relate more with system 2, right? Although a vast amount of majority shows that system 1 is actually in charge 95% of the time. So therefore, it's very important for us to nurture system 2 so that thoughtful, deliberate, analytical judgment prevails. And also when it comes to investment decision making or risk taking, it's better then to think slow. Now, we've spoken about the framework of two minds. We've spoken about the human brain's double processor, but where do biases fit in? So where do these pre-programmed thought patterns actually stem from? So here, I'm going to introduce a new term to you, which is called heuristics. So heuristics are essentially any approach to problem solving, learning, or discovery that employs a practical method. It's not guaranteed to be optimal or to be perfect, but it is sufficient for the immediate goals. Now, I know that's a mouthful, so all in all, if you think of it from a behavioral finance point of view, it's just a simple, efficient rules which people use to form judgments and make decisions. So it's normal, efficient thinking. So heuristics, it allows us to respond rationally and efficiently. To maybe give you an example, if you swerve out for a pothole in a road, that is where a heuristic kicks in. But a heuristic can become a bias when it's applied automatically and inappropriately. Now, we've seen that with the triangle example, and maybe to give you another example, let's say you drive to work every day, you use the same route, so you get into your car, you almost automatically drive to work. You know, sometimes you end up at a location and you're like, I didn't even realize I was driving. So your autopilot kicks in and you're driving to work. So now what happens if it's a Saturday morning and instead of driving to the shops, you also end up driving to work? So that is where a bias is applied automatically and inappropriately. And that could also affect your investment decision making, which I will touch on. Now, before I go into detail on biases, I have to share this story with you. This is a story as told by Morgan Housel. He is a very well-known behavioral expert or psychologist. And he told this story about these two investors. They don't know each other, but their paths crossed in an interesting way. So let's start with Grace Groner on the left-hand side. My left, your right. So Grace Groner, she was unfortunately orphaned at the age of 12. She never married. She never had kids, never drove a car, lived most of her life all alone in a one-bedroom house. She was, by all accounts, a lovely lady, but she lived a humble and quiet life. That made the $7 million that she left for charity at her death in 2010 at the age of 100 all the more confusing. People who knew Grace asked, where did Grace get all the money from? But I can tell you, there was no inheritance, there was no secret. Grace took her humble savings from a meager salary and let it enjoy 80 years of hands-off compounding in the stock market. That's it. Now, a few weeks later, another investment story hit the news. This is the story of Richard Fiscone. He's the former vice chairman of Merrill Lynch's Latin American division, and he was declaring personal bankruptcy and was fighting off foreclosure on two of his homes. Now, Richard Fiscone is kind of the opposite of Grace Groner. He's educated at Harvard University. He was very successful in the investment industry, so successful that he was able to retire at the age of 40 to pursue charitable and personal interest. Now, Richard Fiscone, in the same year that Grace Groner left her fortune to charity, Richard Fiscone said heavy borrowing, illiquid investments did him in, and he stood in front of a bankruptcy judge and said, I have been devastated by the financial crisis. Now, the purpose of this story is not to convince you or to tell you to be all more like Grace Groner and let's try and avoid being or having similar behavior to Richard Fiscone. The point of this story is to show you that this is the only field where stories like this is true. There's no other field where somebody with no education, no real experience, no real connections or resources vastly outperforms somebody with the best education, the best resources, the most relevant experience, and the best connections. To give you an example, you will never find a Grace Groner performing better heart surgery than a Harvard-trained cardiologist. You will never find a Grace Groner developing a faster Apple chip than an Apple engineer. But this is true for investing. And the reason why it's true for investing is because investing is not just the study of finance. Investing is also about how we behave with our money. So to summarize, Richard and Grace just confirms that when it comes to managing money, it's not just about what we know, but it's also very importantly about how we behave. Now, this sets the tone for my next discussion, which is biases, and where we're going to go into more real-life examples. Looking at this picture, we can see the risk of a poor outcome increases as popularity and competition increase. So what we're dealing with here is the power of conformity, or also the inherent herd mentality that we as investors are often guilty of. So as humans, we find comfort in mimicking the behavior of one another. We would rather be wrong in the company of many than being right all by ourselves. And when it comes to your investments, following the herd or following the trend, we know it doesn't always result in the best outcomes. And also, sometimes we are tempted to follow the latest trend, whether it is cryptocurrency, Bitcoin, property, whatever trend there is. Sometimes we are tempted to follow that trend. But we know that money is emotional, markets can be intimidating, and sometimes we can convince ourselves to lead to action because we think, surely they know something that I don't. And surely everyone can't know something that, that I'm not aware of. But what we've seen in the past is that those investors who steer clear of the herd, they often avoid the heartache that comes along with an investment trend that goes wrong at the end. Now, next up, I'm going to show you a quick experiment. It's a short video clip. So this is actually a candid camera clip from 1962. So the quality is not that great, but the message is still very, very strong. And it's called Facing the Rear.
The gentleman in the elevator now is a candid star. These folks who are entering, the man with the white shirt, the lady with the trench coat, and subsequently one other member of our staff will face the rear. And you'll see how this man in the trench coat tries to maintain his individuality, but little by little, he looks at his watch, but he's really making an excuse for turning just a little bit more to the wall. Now we'll try it once again. Here's the candid subject. Here comes the candid camera staff, 3 of them at least. And this man has apparently been in groups before. there's a fella with his hat on in the elevator. First he makes a full turn to the rear, and Charlie closes the door. A moment later, we'll open the door. Everybody's changed positions. Now we'll see if we can use group pressure for some good. Now, in a moment, on Charlie's signal, everybody turns forward. Notice they take off their hats. And now, do you think we could reverse the procedure? Watch.
Try this the next time you're in a lift. So, yeah, this is called the conformity experiments, the Asch conformity experiment. The social psychology pioneer Solomon Asch, he was responsible for these experiments. You can actually Google it. There's a few examples like this. And to be honest with you, we still experience it on a daily basis, this power of conformity. So now this brings me to my next point, and that is that behavior matters a lot. I almost want to be as bold to say sometimes it matters more than the expertise of a fund manager. What we're looking at here is the performance of the S&P 500 on the right versus an average equity fund investor over the last 30 years up until the end of 2022. Now we're looking at US data here, but we might as well could have used South African data. It's just more easily accessible, the US data. And you can see that there is a difference in behavior called the behavior gap, also known as the behavior penalty, which is due to overtrading, trying to time the market, moving in and out of funds, etc. So this study has been conducted by Dalbar. And for those of you that don't know, Dalbar is a research house in the US, and they've sought to understand why is there a difference between the investment return and the investor return. And what they found over the 30 years plus that they've been doing this research is that there is a real difference, a great difference between the two. And that is due to investor behavior. Now, the investment return is the return that you get when you invest in a fund or an index and you stay invested for a particular point in time. It's a fact sheet number, basically. The investor return is where you include all the behavior components, where the switching is taking place or the disinvestment. So you include all of that to then get to the investor behavior. And what we've seen in 2020 specifically, a lot of investors moved out of equity balance fund into lower risk funds, such as our money market fund, in pursuit of safety. Whereas if they actually stayed invested in those higher risk funds, they would have actually earned a higher return. Now that behavior, or those behavioral mistakes, taking place over and over again, results in the behavior gap. And I know that difference looks small, but if you compound that over a number of years, the end value is affected quite hectically. Then why is it that we behave the way that we do, or why is it that this behavior gap exists? So let's have a look at our emotions during investing. And yes, we are all emotional when it comes to money. When markets are rising, we are going through emotions of optimism, excitement, all the way to the top to euphoria. That's usually at the point where we will decide not to leave the fund or the investment because we feel confident in our decision making and we think that the good times will continue. But that's usually at the point of maximum financial risk. Now, it's only when we experience the pain of loss, which is twice as hard as the joy of gains, that we almost feel compelled to get out of the market, to get out of this roller coaster ride midway through. And we know if we try to get out of this roller coaster, it could be detrimental. Instead, we should be buckled up, sit tight, and wait for this roller coaster ride to end. Therefore, it's very important to recognize some of these emotions. Sometimes we need the help of a financial advisor, and then try not to react on them. Now, also, if somebody asks you, how will you react or how will you act when the stock market falls by 30%? You might say, well, it's easy. We just experienced that. I know what I'm supposed to be doing. I'll sit tight and I'll actually see it as a buying opportunity. That is because you assume that the same context will be playing out. But the reason why the stock market falls 30% is because either there's a terrorist attack, there's a banking system crisis, or there's a pandemic that's threatening the health of your family. And given that context, you might then actually shift from an opportunistic mindset to a survival mindset. And then you might actually realize, maybe I don't have the endurance to stay the course. And that's once again where a financial advisor really is beneficial in that relationship. Now, what I'm showing you here is a real life roller coaster scenario. So we're looking at the all share index. The red line is the South African market. It's a log scale. So that's why when we look at the scale, it almost looks like the market just went up one way when we zoom out. Now, it's very painful to be invested in the midst of a crisis. It creates a lot of uncertainty. But at Allan Gray, we've been in existence for 50 years. We're celebrating our 50-year anniversary this year. And we've seen that our valuation-based approach have helped us to navigate through these tough times in the past. And we believe that we will be able to do so in future as well. But looking at this graph, it almost looks like, yes, I believe what theory says. Invest for the long term. The stock market will always go up, but it's not the case. So we often experience a lot of periods of uncertainty. And if we just look at the past 50 years, we've experienced inflation in the 70s. We had South African sanctions in the 80s. We had our first democratic election in 1994. We had no idea where the country was going. Then we had some more global issues, crises, like the dot-com bubble, the global financial crisis, and more recently, COVID. So what I want to say as well is that this time is perhaps not that different to what we've experienced before. And yes, there will be a lot of ups and downs. And often we are fearful to invest at the bottom of the market because of pre-existing behavioral cognitive biases. And those pre-existing biases, psychologists have identified close to 200 of these cognitive biases. Now, I'm definitely not going to discuss all 200 today, but I will be sharing the 3 most widely observed biases that we observe at Allan Gray, as well as within the industry. The first bias is recency bias. Recency bias is the tendency to overvalue the most recent information available to us. Now, that can impact our decision making. It can also cloud your judgment, and it crops up in various aspects of your life. It's not just investing, and it can have negative consequences. We also know that disregarding long-term trends can be detrimental. So maybe to give you a practical example here, let's say you've been invested for the last 5 years, and your average annual return you've been very impressed with. But now all of a sudden, looking at the last 12 months or the last year, looking at the fund fact sheets or your statement, the performance is not that great. Now, due to recency bias, you want to make a judgment call based on the last 12 months, and you decide to switch out of the fund. In that scenario, you might actually capitalize some of those paper losses. And maybe to give you another practical example, we spoke about interest rates today, we spoke about inflation. In 2021, in South Africa, our local prime rate was at multi-decade lows. So we had a lot of people actually buying houses because they could afford it. But the problem is, if they took a step back and actually just glanced at the long-term trend, they would have seen that those low rates will not remain as is. Fast forward to 2 years later, and we can see what happened to the rates. So once again, we should be very cognizant of not making decisions on the recent past. And here I've got a real-life Allan Gray example. So I know there's a lot going on in this graph, but I'm going to explain it in very simple terms. What we're looking at here is the Allan Gray Balance Fund, and we're looking at the return of the fund, which is the line graphs, and we're looking at the flows of the fund. So is there any relationship there? And what we can see while looking at the last 1 year number, so any point on this graph, if you look at the line graph, is the 1 year return number, the previous 1 year return number of Allan Gray Balance Fund. And the point that this graph is making is that if you look at any point on this graph, I mean, let's take 2014 as an example. We saw that the performance was quite high. The alpha, so the relative performance, this is the absolute number, this is the relative performance, was also quite high. And then when we look at the bars, we saw a lot of people piling money into the Allan Gray Balance Fund. So it followed, the flows into the Allan Gray Balance Fund followed the good performance. But now, if we contrast that to 2019, 2020, we can see that performance was not great. And we can also see that the alpha was below zero, so we were underperforming our peers. And what do we see? In the month, in March 2020, when the fund had its lowest performance, when fear was at its highest, we saw the most flows. It actually goes on. This graph couldn't capture all of it, but we had the most flows out of Allan Gray Balance Fund. So looking at this graph, it looks like people are selling at a low and buying at a high, almost irrational behavior. And also when it comes to investing in a particular fund, it's important to keep the objective in mind, because the objective of the Allan Gray Balance Fund is to create long-term wealth. It's to outperform similar funds without assuming more risk. But it's also for somebody who's comfortable with some market fluctuations and even some permanent capital loss. And it's for somebody who wants to invest for longer than 3 years. So I want to say 5 years plus. And what we can see in this scenario is that a lot of investors, a lot of our clients did not stay invested long enough to reap the benefits of the fund or to allow the fund managers to create the value, unfortunately. Now, this next graph, it looks like the same graph. The only thing that I've done here is instead of looking at the previous 12-month returns, I'm now looking at the next 12 months. So what happened in the next year? All of these people that switched out, look at the returns that they've missed out on. So the next 2 years, returns were quite high. And I mean, this is up until April this year. The returns have stayed high, and also the alpha number kept on going up as well. So it just shows you that those investors that switch out of the Allan Gray Balance Fund, unfortunately, they were kind of extrapolating their fear and their perception of risk into the future, and they missed out on the market rally or the fund rally. Now, there's 2 slides that I want to share with you that just helps to put things into perspective. This slide, once again, also look at Allan Gray Balance Fund, and we're looking at the last 20 years. Now, the bar graphs at the bottom shows you the drawdown within a calendar year. Then the red line shows you the calendar year return of the Allan Gray Balance Fund. Now, there's 3 things that I want to mention here. I want to show you that over this 20-year period, there were only 2 years where there was a negative calendar year return. And I know this is a short-term period. We're looking at 1-year periods. Then the second thing is there will always be a drawdown or a little bit of volatility or uncomfortability within a particular year. We can see that as well. And then if we look at 2020, I mean, it was the largest drawdown for Allan Gray Balance Fund. But despite that drawdown, the fund still managed to deliver a 4% return in that calendar year. So this just shows you taking a step back and putting things into perspective, not disregarding that long-term trend, could help you with the way that you think about investing and how we behave. Now, another slide just to also support this point. This is actually my favorite slide. You might have come across this slide before. We call it the funnel chart. And what it is a graphical representation that with time comes certainty. So what we're looking at here is over a 1-year period. These are rolling periods. Over any 1-year period, since Allan Gray Balance Fund's inception, you could have experienced the return of minus 14% or plus 46%. So you can see that can create quite a bit of uncomfortability over a 1-year period. Then as we increase the rolling periods, you can see that that variance is becoming narrower and narrower. So that's why the longer you invest, the higher your chances of actually achieving a real return. And then also, volatility in the short term, it's inevitable. We believe that you need the volatility in order for you to create those real returns. Now, next bias that I want to discuss that we often come across is loss aversion. And for most people, including myself, the market drawdown that we experienced in 2020 was the first real big drawdown that we've experienced. And I mean, it's very painful when you see your investment decreasing by 30%. And that pain doesn't go away quickly. And the reason why that pain lingers is because of how our brain works. So our brain works the same way as it works when we have experienced a physical pain. So scientists have discovered the way that our brain reacts to an emotional pain that comes along with a financial loss is very similar to a physical pain. So what our brain then does is our brain stores that memory to protect ourselves from future harm. So that is why a lot of people, when they experience the drawdown in their investment, they wanted to switch out in the short term to prevent that from happening again in future. And a second reason why we are so affected by this pain from loss is because we place a higher value on something that we own versus something that we don't own. And if that something is your investment and some of it gets taken away from you, even if it's just temporarily, the pain that you experience is far greater than the joy that you actually experience when your investment rises back up to where it was before. Now, we can't remove this feeling of pain, but what we can do is we can determine which losses are temporary and which losses are actually permanent. Now, I've got another example here for you. I've modeled 3 investors. These investors started investing in January 2020 up until April 2023, so just slightly more than 3 years. The first investor invested in the Allan Gray Balance Fund, which is our flagship fund. The investor stayed invested despite the fund having a maximum drawdown of 25% in 2020. So this person just sat tight and stayed invested in the fund. The second person did not want to partake in the market at all. This person decided to invest in our lowest risk fund, which is our money market fund, which invests in money market instruments. And looking at this specific behavior, you could say, well, perhaps this client had a crystal ball because this client managed to avoid the drawdown that we experienced in COVID. And you might think that was the better strategy, but that was the preferred strategy for a very short period of time because the market drawdown that we've experienced was sharp and brief. And then what happened? Bonds and equities started outperforming cash again. The third investor started off very confident, investing in the Allan Gray Balance Fund, which matches his objectives and goals. But then, as I said, when fear was at its highest, this person decided to switch out into the Allan Gray Money Market Fund in pursuit of safety. And then a year later, when sentiment turned positive, switched back into the Allan Gray Balance Fund. But what we can see here is that this person actually ended up with a capital loss. This person was realizing some of those paper losses by switching out at the bottom and then switching back in later. And here we can have a look at the values. That person managed to achieve an annualized return of lower than 2% versus the person that stayed invested in the Allan Gray Balance Fund, which resulted in an 11% return. So once again, I know those numbers, I mean, when you look at the values, you can see the actual effect that it can have on your investment. So despite the pain, staying tight and just staying invested was the better course of action here. Now you might say, well, that is one point at a time. That's one example. So what I've done is I've looked at longer term periods. So here we're looking at the last 20 years, 10 years, and 5 years. And I want you to focus on the last 20 years. So once again, if somebody stayed invested in the Allan Gray Balance Fund for 20 years straight, the return there would have been 13.1%. But if someone missed the top 5 months by maybe switching out, when there was a lot of fear in the market, the return there is 10.9%. And looking at the numbers, it's about 2.2% difference in annualized return. But if you compound that over a 20-year period, it's a third difference in value. So the investment value of the person that missed the top 5 months was a third less than the person that stayed invested. And you might also say, well, okay, how did this person miss the top 5 months? Because the issue is there's often concentration between the top performing months and the underperforming months. So to give you an example, the worst performing month for the Allan Gray Balance Fund was March 2020. The best performing month was April 2020. So that's why a lot of investors who maybe try and time the market, they miss out on the market rallying, and that's why there exists that behavior gap. Now, the last bias that I want to discuss is confirmation bias. It's a bias that I'm also guilty of. It's a tendency of gravitating towards news and opinions that supports or confirms our own views. And in an information overloaded world, it's very easy, whether you are a novice investor or a professional, to find evidence to support your own theories. And with the evidence in hand, it's also very easy to then justify our actions. And confirmation bias, it manifests in the papers that we read, the websites that we visit, the people that we listen to. And online, we are also being manipulated by search engines, by news sites, by social media networks that is very cleverly configured to provide you with exactly what you're looking for based on your historical behavior. So this is a bias that we see playing out, and this bias also often leads to misleading popular market sentiment if you aggregate it across the market. Now, looking at this graph, it shows us the S&P 500 again, and we're looking at the decade just before COVID. So 2009 up till 2019, the market went up. It was a great place to be invested, 495% return. However, you would have been challenged by 30 plus different events of why you should not be invested in the market. So when you consume financial media, there's always a reason for you to sell. As we know, bad news is a lot faster than good news. However, we know that our default should be not to action on this news. But it's easier said than done. Because if you are a regular consumer of financial media, there is disaster looming around every single corner. Then, this is the next graph that we actually don't often see. And this is the reasons to buy. So this shows us the gradual improvement. And Bill Gates, he said, headlines in itself is what is misleading. Because headlines is bad news. Headlines is not gradual improvement. And to just give you a few of these examples, advances in medicine, thinking about lowering the cost of financial products, making sure that we distribute high-speed Wi-Fi across the US. Those are a few examples that have actually managed to support the returns of the stock market that contributed to that 495%. But we don't see that in the headlines, unfortunately. So that's why it's very important when we consume financial media that we have a targeted strategy in how we filter through this information, that we focus on the facts, that we separate the wheat from the chaff, that we actually also challenge our own thinking. Maybe they call it the teams of rival approach, where Abraham Lincoln appointed rivals in his cabinet to also just challenge his own way of thinking. So there are many things that we can do to think more critical about what it is that we consume, because that could then affect our behavior. Now, there's two last points that I want to make. This is a sketch from the behavioral finance guru called Carl Richards. You can definitely follow him. He puts together these very simplified sketches, but they're very powerful in what they're trying to tell us. And what this sketch is saying is focus on the things that matter and the things that you can control and try and forget about the rest. And what we mean by that is we're almost, I don't want to say indoctrined, but maybe conditioned to think that the rate of return is the most important thing when it comes to your investment. But actually that's not the case, because there's many other levers that we can pull on or that we have control over. We have control over our biases, the way that we behave. We have control over when we invest, how long we invest, our risk profile, how risky we invest. All of those things we have control over. And we also have to accept that a great deal of what's happening in the economy When is the Fed going to start decreasing interest rates? When is load shedding going to come to an end? All of those things we don't have control over. But it's encouraging and empowering to know that there are still many decisions that we as investors can make that can positively influence our investment outcome and therefore our financial future. Now, you also don't have to navigate this journey alone. This is where I want to touch on the value of an advisor. So we've seen how important investor behavior is when it comes to investing, and this is where an advisor can act as a voice of reason as well. Often we have blind spots, we have those biases, and I mean a lot of advisors, they have their own advisors as well. So Carl Richards, the behavioral finance guru, he said there's 3 reasons why he's got a financial advisor. The first reason is to help him clarify his goals. The second reason is he needs somebody to remind him what is important to him when he's about to do something silly. And then the third reason is he needs somebody to stand in his way from making a big mistake. So those are the reasons why he has decided to partner with a financial advisor. And then just to end off with, just to bring all the points together of what I've said today, I want you to focus on nurturing that system too, especially when it comes to important decision making, such as taking on risks or for your investments. And then when it comes to uncertainty, it's part of our daily life. It's part of the investment world. And I know Allan Gray, the man himself, he used to say, for as long as humans are emotional with regards to their investments, there will be a job for an active manager. And we see that playing out over and over again, where fear and greed kicks in, where emotions kicks in when it comes to investing. And then we spoke about the importance of adopting good behavioral habits. We've gone through a few of those examples. And then focus on what's within your control. And then the last point there is, if you need the help of a financial advisor, get that accountability partner, somebody that can also maybe pinpoint some of those blind spots that you might be guilty of. Great. That's it.